Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, I feel like I start every private credit episode with the same point. But I mean, private credit, it's everywhere right now. I think I counted like dozens and dozens of stories on private credit that came out just on the Bloomberg in the past week.
There's two funny things that are going on, which is one, private credit. So these non-bank entities providing loans, et cetera, wanting to get into credit, and there's more and more about that every day. And then there's banks wanting to get more and more into private credit, which is this own thing of, okay, you're still the bank, but you're doing it in some sort of balance sheet structure that resembles private credit. And what's up with that?
What's up with that? Indeed. This is the What's Up With That episode. I'm so glad you asked that question, but we're going to be talking about the relationship between banks and private credit. Because the other thing that's been happening is every time we talk to a bank or a private credit entity on this show and we ask about the relationship between regulated banks and non-banks, you get this really diplomatic kind of awkward answer. Like, well, we view our bank partners as opportunities. And no one will really explain how they actually feel about each other.
Totally. You know, the one other thing before we get into it that I think about it a lot is I look at the rise of private credit, and there is a big part of me that says, this is what regulatory success looks like. Mm-hmm. This is what post-Dodd-Frank success looks like, that there is more of this risk-taking activity.
This was the intent.
Yeah, happening outside of the deposit-taking banking institution. On the other hand, if a lot of the leverage for private credit and a lot of these relationships is being plied by banks and so forth, then it makes me wonder, did we actually extricate the risk? Or in the end,
we just put a wrapper on it.
We put a wrapper on it. In the end, does all financial risk read down back to the banking system?
That's exactly it. And I got to say, you know, there is a lot of discourse from which we can pull from, a lot of historical analogies, because, of course, bank disintermediation is not a new thing. No. It's basically been happening for as long as we've had banks. And if I think back to like two big moments in the process of bank disintermediation, it has to be the invention of the junk bond market in the 1980s, securitization also in the 1980s and 1990s. Peer-to-peer lending, that was a fun one. Remember that?
Well, the other thing, too, you know, it just occurred to me, and Bear Stearns was not a retail deposit-taking institution, but part of why they blew up is like they had these in-house hedge funds, right? And so even this idea of hedge funds and non-bank entities sort of existing within more larger traditional regulated financial institutions is not that new. That was a story of the great financial crisis.
That's exactly right. So I'm very happy to say this is our banks and private credit, basically frenemies episode. Yeah. We're going to be speaking with really the perfect guest. It's someone that I've known for a long time, and we've actually had him on the podcast before, but I don't think you were there. I promise you are really going to love this. We're going to be speaking with Huw van Steenis. He is the vice chair at Oliver Wyman and also the former global head of banking research over at Morgan Stanley. That's where I got to know him during the depths of the Eurozone financial crisis when I was on FT Alphaville. He's also formerly an advisor to Mark Carney at the BOE. I think he won like a series of research awards at various points in his career, but really one of the smartest guys I know when it comes to banks and financials. So Huw, thank you so much for coming on Odd Lots.
Oh, well, Tracy, thanks so much for having me on.
We are very excited. First of all, maybe let's just start with the basic question, because everyone seems to have different opinions, different numbers around this. But how big is private credit at the moment compared to the traditional banking system?
Oh, I mean, honestly, it's pretty tiny. So the official stats are about 1.7 trillion, and that's by Preqin, the company that BlackRock bought recently. That number, though, doesn't include insurers giving direct mandates to the private credit firms. So I think it's probably closer to 2.5 to 3 trillion, which is a drop in the ocean to what? Investment grade bond markets, 9 trillion. Banking assets in Europe are 32 trillion. These are really relatively small numbers. And so I think that's why many of these firms think they've got a long runway still to grow.
So why do we care? It's not because they're so big. It's just because it's growing fast.
Well, it's also because they're eating away at bank earnings. And I think that's where, if I think about our conversations with bank CEOs and CFOs, and I literally just had one before coming on your show, they're worried about how much of their juice is being gobbled up. And I think that's why, in a way, Tracy's right, it's gone from sort of counterparts to frenemies. And one way to think about it is that we had a very unusual macro period, as you've spoken about many times. During 2023, private credit players wrote about 90% of all leveraged loans. And they're also doing really well in direct lending. And so they're looking for the next avenue of growth. And one theme that we come up across a lot is about asset-backed lending. So in other words, financing, aviation or auto loans or even royalties. That's a $5.5 trillion market in the States. Private credit probably has less than 5% share, and they're really looking to mine this seam. And so if you're a banker thinking, these guys are now after our investment grade assets, not just the high yield assets.
So talk to us about how we got to this point, because Joe correctly, I think, attributed this to a lot of the post-2008 redesign of the financial system regulation. And I mean, this is what we wanted, right? We wanted the riskiest stuff, the riskiest activity to be pushed away from regulated banks and into, I know they have the nefarious name of shadow banks, but, mostly we're talking about like a business development company or a direct lender or someone like that.
No, I think that's right. So look, if you take it since the financial crisis where we changed the regs for the banking system, a lot more capital, a lot less, shortened the asset liability duration mismatch that went beyond an elastic limit into the financial crisis. So these private credit firms have created just over $1 trillion parallel system to lend to corporate America and parts of corporate Europe. And it's around leverage lending. It's areas which were either too risky or in some cases where the Fed put in limits on how many leverage loans or what was the maximum multiple of leverage that a bank loan could take on. And so these loans were being pushed outside of the banks. The other area, though, where private credit has been very active too is mid-market. So let's say a loan between, $30 million to $75 million. That's an area where, for the top 6 banks, this is just too small fry for them to get excited. And therefore, also, there was a missing piece, which, the private credit firms picked up the crumbs which are left on the table by the banks. So you're right. I think the regulators pushed this. I think where we're going now is probably to the next level. And so the way I think about it is that we are now retranching the banking system, where the banks are laying off the junior risk to private credit. And that's allowing them to optimize their capital, but quite frankly, also lend more. And so what's really interesting for me is there's, like everything in life, people see things as an opportunity or a threat. The top banks and CEOs that I talk to are now saying, actually, private credit allows me to recycle risk more quickly. I can lend more. And then there's a whole bunch of banks who are just sitting, licking their wounds, going, I'm not sure how I can do this. So I think there is a little bit of symbiosis now between the banks and private credit.
Sorry, explain that a little bit further, at least on the opportunity side, when they can recycle their capital faster. Just sort of walk us through that.
Yeah, so Joe, let's take one of the top US banks or European banks. So there are 3 ways they can lay off risk. The first would be to say, I will cede the loans that I don't really want to write to give to a third party. Okay. So in a way, what you've seen with Apollo and Citigroup is the leverage lending, or Brookfield with Lloyds in Europe. Again, it was around leverage lending. So it's stuff that they didn't really want to do, but they can arrange, they can get all sorts of origination fees, and then they can also keep the relationship. The second is if they, let's say, originate a loan, they then pass that up, maybe get 100 loans, 120 loans, and then do a synthetic risk transfer around this. So in other words, start to basically, which I think you talked about 2 months ago on your show. So in that case, think about a bell curve. You're going to insure the bottom 10%. You're going to take off the tail. And from a bank capital point of view, that dramatically optimizes your capital at risk. So the Fed only permissioned this about 9 months ago. You've already seen Morgan Stanley, Goldman Sachs, a number of firms start to do these synthetic risk transfers. That space, I think, is going to grow really strongly because for the largest firms, it allows them to lend and then do that. And then the third is then the more, there's some more complexities as well around, how else you can sort of lay off the risk.
So one thing I'm always asking on the show is how these conversations begin, because, I honestly have no idea. Like, clearly, there's a lot of partnering that's happening between banks and private credit at the moment. But when did that start in your mind? What was the first kind of big, notable instance of a bank teaming up with some sort of private credit entity?
Oh, that's a good question. So as you sort of hinted earlier on, Tracy, often in life, the history of these things is far longer than we like to believe. So just like actually 1973 was the peak of bank lending as a percentage of lending to corporates. I mean, it's 50 years since that peak. So you're right. Some of these partnerships are actually about 15 years old. One or two of them predate the financial crisis. But if you think about today, in the 12 months to September, 14 banks tied up deals with private credit. And in the 12 months prior, it was only 2. So it's basically about a year ago, suddenly it snapped. Now, why is that? I think it's because the private credit firms, particularly the top 10, felt they'd started to max out of, leverage lending or direct lending. But I think the subplot is much more Shakespearean. I think there's a really interesting subplot, which is more of the top 10 private credit firms are now getting their assets from insurers. So take yesterday, we had the Blackstone results. Half their assets now come from insurance companies. Insurers can only invest in investment grade. So if you think about it from the point of view of the private credit player, they are structurally lowering their cost of capital, which means that they can then go after investment grade assets on the bank's balance sheets. And so that subplot, I think now of the top 10 firms, on my numbers, about 40% of the assets come from insurers. They become much more relevant to compete for the investment grade pieces on the banks. And I think that's what, whether it's the Barclays deal with Blackstone, whether it's Oaktree with SocGen, whether it's Citi with Apollo, in a way, the private credit is able to nibble away at more assets than they could in the past.
I'm going to back up and ask the dumb question. I'm like, I think maybe listeners will want a clarification, but it's actually just me. What's the difference between leverage lending and direct lending again?
Oh, look, this is one of these where nomenclature is pretty poor.
Okay.
I mean, it's really poor and it's pretty blurry. I think the way they think, most of them would think about it, is direct lending is I'm lending to a mid-market company, $30 million to $100 million, the kind of area, mid-market finance. Whereas leverage lending is going to be acquisition-related finance. But
got it. Yeah.
But Joe, it's a blurry Venn diagram.
No, the acquisition-related finance, that makes a lot of sense to me.
So I'm going to go back to that conversation point and ask, okay, so, a bank approaches a private credit lender, or a private credit lender approaches a bank and says, hey, we need to do something in this environment. There's a lot of demand. I've got a bunch of insurance companies that are interested, whatever. How do they go about identifying what exactly they're going to do and which particular assets or loans might be realistic for this kind of partnership?
Oh, that's a great question, Tracy. So, look, some of these these firms have been counterparts of the banks for many years. So there's a degree of relationship, even if maybe historically been a little bit antagonistic. And certainly one of the leading private credit firms, has a swear box for every time they talk about a counterpart rather than a partner these days.
Wait, how much do you have to put in? Is it like $5,000 or $5?
Well, it probably should be 5,000, but I think it's the charity. It's a charity pot. And so if we think about those deals, half have been around asset-backed lending and half around the overflow, the leverage finance, or the more levered stuff. So I think what the private credit companies are doing is very shrewdly going through they're almost doing like my old job being a banks analyst. They're looking at a bank and saying, where is capital constrained? At the end of the day, particularly in Europe, but even in the States, even particularly think about US regional banks or some of the European banks, they've become optimizers. They're optimizing for a cost efficiency, capital efficiency, and revenues. And in that mindset of optimization, they're always looking to try and lay off risk. And so the private credit company often says, well, look, I see you're capital constrained. You need to grow. An example would be, let's say, Blackstone with Barclays. They want to grow their credit card business, but equally want to keep lots of money in their investment bank. By partnering up, they can now fuel the growth of the credit card business in a way they couldn't do before, or at least didn't believe they could before. So I think this is, in a very constrained world. In fact, I was at an event last week with a bunch of investors and private credit firms, and one of the investors said, well, look, there is not enough capital for any bank to put capital behind an acronym. That's just space is gone. You need to find partners. And so I think they're forensic. They're hiring people to do banks analysts for them, and then they're looking to try and create a solution. Because I said the top 10 firms feel their origination constraint, and so they need the access to more assets.
So in a situation like a credit card deal, what the bank wants and the bank still has, and the bank will probably still have, is that brand, that relationship, that retail distribution network, and so forth. And then the private credit entity just allows them to keep growing these lines, and there are presumably other lines, without impairing their balance sheet.
Exactly. It's about optimizing for capital as well. Because, it's at the end of the day, if you take off the riskiest piece or take off the entire slice, then you can just grow much faster.
That's very helpful. Can you go further in talking about the role of insurance and all this? Because one of the things that I still find actually completely strange is that we have these gigantic financial entities called insurance companies. They're mammoth and they're important in all kinds of areas, and no one ever talks about insurance companies. There's you don't really see them in the media the same way you see banks. It's very strange.
That and accounting.
Yeah, that and accounting.
Like the two missing major ingredients of financial journalism.
Of the financial ecosystem that seem to punch, and maybe they like it, and punch at 10% of their weight in terms of our understanding of their role. But talk a little bit more about the role of insurance capital in all this.
Oh, this is a great plot. And actually, it's very different in Europe versus the US.
Okay.
But let's say, if you go back to Tracy's point, the railways were funded mostly by insurance companies. I mean, large capital projects were mostly funded by the insurers. So, because they had long-dated funding, and you still had Wildcat, runs in the States, as you may not remember, but it was there. So everyone's looked at Apollo and their arrangement with Athene, and seeing that they've created they've got a very stable source of funding through their annuity business. Much like you might have seen through before the financial crisis, hedge funds wanted permanent capital vehicles.
Right.
Everyone wants to be aligned to long dated capital, and so I think most of the top 10 now have an insurance business. So I listened to the Blackstone call yesterday. 221 billion of their assets are now from insurers out of 432. So over half of their credit assets come from insurers. Now, obviously, that's great because these are investors with long duration liabilities who need long dated assets. So they're the right kind of people to fund data centers, infrastructure assets, the long dated and stuff we need to fund our growth. But the interesting thing for private credit is, rather than having to go for, 10 to 13% return, if they can just simply get 100 to 200 basis points more than the insurer could have got through the public markets, they're actually quids in. And so certainly the expectation for the CIOs of insurers I speak to is, if they can get 150, 175 basis points pickup on a single A bond by buying a private bond rather than a public bond, if you compound that over 10 years, that's huge for the insurance sector. And so, as I said, I think about 40% of the assets now of the majors come from insurance. I think for the industry as a whole, it's probably nearer 30. And so that's fueling the growth, and it's changing the nature of where private credit can invest.
By the way, Tracy, I didn't know that insurance companies funded the railways, but I will say early on in my career, I do remember, and I sort of pat myself on the back for this, I do remember having the realization that sort of clicked how similar banks and insurance companies are. Because with the bank, you make a deposit of $1,000, and over the lifetime, the bank will probably give you back your $1,000 in the form of you take it out. Insurance companies basically the same. You buy
collect premiums, pay it out,
and you get the on
sometimes.
Average. No, but on average, right, for the industry, they pay out roughly what they get in, and they hope to make it on the float kind of. And so in the end, the model is in the ideal sense. It's just a matter of timing of when the cash comes back out. But
in aggregate,
right,
certainly.
In aggregate. But
it's not my individual experience.
Some people get screwed, and some people get way more than they put in, and then on average, anyway.
Yeah.
That sort of clicked to me one time in my young years.
There's a lot of overlap here for sure. Okay, so I want to go back to the financial risk / regulation point. So we've established a number of times that to some extent this is exactly what regulators wanted to see happen. But I think there's always a concern that maybe this will come back to bite them and the overall financial system in some unexpected way. And that maybe there are avenues that some of this risk is still entangled with the banking system, especially as we see these new partnerships develop. What are the avenues for private credit risk to, I guess, re-enter the banking system and potentially cause problems?
Look, I think it's a great question. I think I've had almost every regulator pose this question. Which is one of the very hot buttons for the issue for them. So look, my take is that for a sector which is very low on leverage, doesn't have the big asset liability mismatches, is not systemically interconnected, and to be honest is still relatively small, less than 3 trillion, it's on the whole not a source of systemic risk. But the question you get are therefore, well, are there pockets of leverage that we can't see? So, for instance, the Bank of England's got an investigation to think about where is the hidden leverage, because obviously having had the LDI problems under Truss, they're worried about hidden leverage. So NAV finance is an area which the regulators are poring over and are trying to get the data from firms just to see is there leverage on leverage in the system that may trip them up. I think second would be, on the whole, if you've got 10 plus 2, so if the funds are 10-year in duration, or even if they're 6 years, and you're lending to 5-year loans, there isn't a big asset liability mismatch. But to the extent that private credit may potentially be put into retail vehicles or even to ETFs, is there going to be an asset liability mismatch? And certainly the more that private credit looks to raise money from retail, the more there's going to be questions around the structure. And we can come back to that because there's a Cambrian explosion of interest of traditional asset managers and private credit players teaming up to create commingled vehicles. And then the third, though, but Tracy, to your point is, how do the tentacles overlap? So there was a good piece by Liberty Street, so like the Fed in New York, that 27% of bank loans are now to non-bank financial institutions. So hedge funds, private credit, private equity and the like. And it's been growing like a weed. And so they're warranting, at one level, they're very happy that firms are laying off risk to private credit. But the question, in fact, one of the big central banks is asking the banks to try and tot up every loan to private credit firm A, every loan to private credit firm B. Now, in reality, they're not making the loan to the firm, they're doing it to the underlying asset, but they want to have a consolidated tape because, what you don't know scares you. And so they're trying to get a much better transparency on this space.
This kind of reminds me of the conversation we had with Mickey Shemi about synthetic risk transfers, where, it's sort of the same idea. The bank is like selling off part of the risk of a loan portfolio to another entity. And that sounds fine, except sometimes those other entities who tend to be hedge funds or someone like that are borrowing from banks in order to apply leverage to boost the yield.
Yeah, say more about that 27%. I have to go read that Liberty Street economics report. But what is, from the bank's perspective, that specific type of lending? What are the risk characteristics? What are the capital impairment or the capital cost characteristics of this kind of activity?
Well, look, so by the way, I'll send you the notes. I think it's about where do banks end and private markets begin, or non-banks begin is the title. So I think, look, it's very heterogeneous at the moment. Yeah. So it's hedge funds. And I know that my good friend Torsten Slok said that's to a new high. It's to private equity firms. So it's all over the place. But sorry, I'm just thinking. Sorry, Jake. Go back again.
I know my question wasn't particularly. I know my question wasn't particularly cogent here. I'm just.
My answer was worse.
That's fine. No, it's fine. It's fine. I'm just trying to understand. Okay, so banks are optimization vehicles. They're capital optimization vehicles and so forth, and they want to do the lending that creates the fewest constraints on the size for regulators and all that stuff. So where does lending to financial institutions fit into this sort of matrix of costs and benefits?
Okay, so the way bank regs work these days is to encourage the banks to do senior or high quality lending and to try and limit the amount of riskier lending, either to try and originate and distribute it very quickly or to lay it off through, derivatives of some sort. Yeah. And so let's say it's lending to hedge funds. Now, as you've spoken about before with Archegos, they got that wrong. But the idea was up until then, hedge fund lending had been very low risk for a long period of time.
So this is kind of hedge fund lending is considered to be low risk.
Absolutely.
Why?
But I think that is changing. There's more scrutiny of the prime brokerage business.
Why?
Exactly. Well, because they had a 15-year run with almost no credit losses, and obviously they had good collateral with haircuts. And this was the big question with the firms who got the wrong way around Archegos, was if they got the right haircuts, then it was secured lending. So on the whole, they could seize the assets and sell them off. What they got wrong was this was such a concentrated pool, and they were all stampeding. So I think actually the risk here is not so much the belly, it's actually the tail. So is there a scenario where there's a major credit event and that many companies go bust, and then that works its way through? And that's where the regulators are trying to piece it through. But my take is, on the whole, the banks are trying to retranche, keep the senior risk. And I cheekily put in that this is with the Ozempic of the system, because this was a way for them to lay off risk.
This was actually very helpful, because in my mind, just sort of very naively, I don't necessarily think, lending to hedge funds is really safe lending, because aren't they taking all kinds of crazy risks and doing all kinds of stuff that may go wrong? But to your point, obviously beyond just the run, the fact that it's backed by actual assets, typically the bank knows what the assets are. I can understand more conceptually why lending to financial institutions is more frequently perceived as safe. So thank you for that.
Joe, I think we should do a prime brokerage episode of Odd Lots where all we do is a dramatic reading of the report on Credit Suisse and Archegos.
Yeah, let's do that.
And we just do that, because that was amazing.
We can get actors for it, yeah.
Well, actually a really good insight into how it all works, or, a bad example of how it should not work. Anyway, Huw, I'm going to ask a really basic question, but I find, the changing answers to this one always really interesting. But how are banks making money now?
Good question.
That's a really good question. So after 15 years of zero or negative rates, we've had a wonderful couple of years where spread income, so the spread between the assets and liability, once again became profitable. And that really hurt the banks. But, if the majority of my conversations, both stateside and Europe, and even in Asia, is the banks want to make more fee income. So that could be asset management, could be private banking, could be originate to distribute. They want to continue to shift more and more of their earnings towards fees and less from just common and garden banking. And that's partly cyclical. As interest rates are being cut now, the anticipation is the spread is going to be under a little bit of pressure. But, as we've seen, actually, it continues to be very good. But it's more and more fees. That's really where the banks are focused. And then within the loan income, my sort of take is that the kind of winner takes most dynamics we've seen in tech are starting to come to banking. The more of a bank's cost base, which is the systems, the cloud, data, it's more and more the cost base is tech. Well, quite frankly, it's very scalable. And so what you're starting to see, if you look at the ROE, I actually did a piece the other day where I looked at the ROEs for the banks in every country by the number one player, number two, number three, number five. The top three players in each market are doing so much better than the tail than they were a decade ago. And I think it's that winner takes more behavior.
That's really interesting. Let's talk a little bit more about this, because I have also from time to time pull up the chart of JP Morgan and compare it to other banks. And it looks kind of like a tech stock. I mean, it's not really quite as good because it's not a tech stock, but it sort of seems to exist. And I wondered about this sort of winner-take-allness of the market and whether there is a similar dynamic. And I hadn't thought about it quite so literally in terms of the actual tech stack of the bank. And I was wondering if it was more sort of like a network effects. And of course, in finance, network effects are important just like they are in software. But talk to us a little bit about the dynamics that you think are contributing to this winner-take-allness in any country's banking system.
So look, I think obviously part of it is the tech stack. Of course, if they're trading assets, there's always going to be some network effects. If you can take, 13, 14, 15% of a market, you just see more, you can price better, you've got better source of flow. So I think in investment banking markets and in sort of wealth markets, there's definitely some network effects. But also just there's scale in origination. I mean, you just need loan officers, loan processors. I mean, it's typically it's very manual. And in fact, one of the, not for me, but some of our colleagues are doing a lot of work actually using AI to automate loan procedures for banks, because that's an area which is historically been very labor intensive. And actually, one of the reasons why private credit is trying to team up with the banks is because they don't have enough people to originate, so they're trying to lean on someone else's origination stack. Now, look, there's one nuance here. For every power, there's an equal and opposite power. So in the States, let's say, for the smallest banks, they're all basically sitting on one of three players, like Fiserv. So they're enjoying scale, but they're just outsourcing it. And then the other thing is, of course, the Googles, the Alphabets, and Azure within Microsoft are winning hand over fist, because if you're a mid-cap bank, the way you try to capture scale is by outsourcing to one of the superscalers.
I think you anticipated my next question, perhaps, when you brought up AI. But one thing I often think about the financial sector, so banks and insurance companies, is if AI is obviously it's about the technology, but it's about the data too. Who has the most data? It's got to be insurers and banks, right? They just have oodles and oodles of it. How excited are banks in particular getting about, the actual data component of their business here?
Well, hopefully Bloomberg's got one of the best data stacks.
Oh, well,
in the
us
markets,
too,
at least.
of course.
Yeah, but there's a huge amount of automation going on. I mean, look, let's take one step back. The banks need to make sure that their data is organized in a lake or in a way it can be used effectively. And then number two, you need to train. So actually, one of the largest banks now has every new graduate doing AI prompt training as part of their core curriculum as they join. So one of my son's flatmate has just done 8 weeks of AI training. It's extraordinary. So the way, of course, if the more data you've got, the better. But Tracy, there's some really subtle things in here because the regulators want to know how you made those decisions.
Right.
And is the AI optimizing just on past experience, or is it...
Right. This is the black box algo point, right? Where
Exactly.
if you have all this data going into a black box and algorithm and it's spitting out an answer, you actually have to know whether that answer is valid, like whether it might violate regulations on biased lending based on like racial or age characteristics or gender or something like that.
No, absolutely. And so there's all sorts of biases. So at the moment, most of it is for co-piloting. But, some of the use cases, Tracy, are fascinating. It's like one of the big banks I was talking with, they're actually using AI now in their HR departments to just basically automate anything. If they want to fire someone, they click a button and try and work it out.
Oh, wow. Dystopia is here.
Yeah, it really is. There's some great articles, by the way, done by Bloomberg, not related to banks or anything, but like on the sort of like Amazon auto hiring and firing and just this idea of all that being the assumption of liquid labor markets and it's okay to make mistakes if there's just an endless supply of people who want to work at your company. Anyway, that's its own digression. Just on this point, so obviously, okay, the big banks have their gigantic tech stacks. I had a conversation recently with someone who worked for a very small bank, actually. It was just like I met someone over coffee because, I'm curious. And so it was like kind of like doing an Odd Lots except over coffee with no microphone, like how it all works and how a regional or a small local bank actually has a business. And it was really striking in the conversation how many of the specific things that came up were literally about third-party modeling or software packages and stuff like that, and how much the sort of all kinds of risk management, et cetera, it was really a job of plugging their numbers in to various packages that they buy. And I have to imagine that the companies that sell these modeling services or software services or data services to any of the banks that aren't like JP Morgan and a few others must be making a mint.
Oh, absolutely. Look, I mean, that's not my specialist area.
Yeah,
I know. Yeah. But just in the same way that MSCI has made an absolute fortune by being the premier data company for markets. So, I mean, one way to frame it is in the sort of 15 years post-financial crisis, the banks, in many, at least certainly for the first 7 or 8, were just focused on capital repair, improving process, improving risk management. The amount of discretionary budget they had to invest in new tech stacks was really quite low. And so a lot of the innovation was happening outside banks and being sold back in. Now, as you say, look, from maybe 2016 onwards, the US banks got back on the front foot. And the leading ones are investing disproportionately in tech and their own solutions. But there's an enormous amount which is bought in. And again, that's why if you go back to private credit, one of the areas they hope is that certainly the leading firms are also investing in tech stacks because they want to make sure they have an information edge. And so also you're starting to see, I wouldn't say hollowing out of the middle in private credit, but definitely the larger firms are investing very significantly in treasury management, data management, and the like.
By the way, Tracy, look up a chart of Fiserv stock, which does a bunch of various payment things for smaller and credit union banks and stuff like that. And check out that.
Oh, geez.
Yeah, check out that stock
chart.
I just pulled it up.
I have to compare it to NVIDIA. Hold on.
Right. I know. It looks like it, doesn't it? It's probably.
Well,
so anyway.
Yeah, that's amazing. Why don't we get back to private credit? Because
okay.
we're in danger of just making this an AI episode. But Huw, we've seen growth in private credit, although to your point, it's still relatively small. So, it's coming up from a low base. We've seen more partnerships between banks and private credit entities. What's next in terms of this dynamic? What are you watching out for as the next big thing?
So for me, private credit's next act is around asset-backed lending and secondly, commercial real estate. And I think they're the two big asset classes which the private credit firms are really trying to either gain origination or do partnerships or get into. And just go back to it. So if specialty finance is a $5.5 trillion market, private credit has about a 5-point share. If you then include consumer mortgages and commercial real estate, it gets to about 25 trillion in the States, of which private credit has probably about a 2% share. So this is an area where they are really trying to say, with insurance-led assets, with also some of the assets for the wealthy, this is where they're really gunning for it. Now, at the moment, commercial real estate is probably less picked over because the areas where the banks are shedding is more the distressed or stressed, particularly if it's a US regional bank. But the asset-backed lending piece is they're going absolutely gung-ho, and that's the area which I think is probably one of the most interesting areas to spend time on. And then the second bit, Tracy, is that's obviously on origination, on where they're getting the assets from. As we've spoken about many times before, let's be honest, the endowments and pension funds are still have got a bit of indigestion to private equity and venture capital. Now, that indigestion's passing, but most endowments I speak to still say they're about 5 points over allocated to VC. Would love to put that to private credit, but they just don't want to do more illiquid assets today. So the private credit firms are doing three things: going international, so going to the Middle East in particular, where there is just a ton of new money, and actually those clients really like fixed income. They're going to insurers, and I still think there's a good runway to raise money from insurers we could discuss. And third, and finally, it's the wealthy. And I think at the moment there's a little bit of a misnomer. When they say wealthy, they mean seriously wealthy. I mean, they talk about, family offices, people with $50 million plus. There's about a $9 trillion market of family offices globally. That's their sweet spot. But they're going to look increasingly towards the decently wealthy. And I think the product innovation around, whether it's Capital International with KKR, whether it's BlackRock with Partners Group, whether it's Apollo with State Street Global, there's some really interesting innovation about how you slice up private credit to sort of like affluent clients. And that's something, again, you could do a whole episode on.
Tracy, we've never done, I don't think, a family office episode.
We should.
Yeah.
We should go to Singapore and do it from there just because I want to go back to Asia. Okay, well, Huw, thank you so much for coming back on the show. It was lovely to catch up with you as always, and you walked us through that perfectly. So thank you so much.
Thanks for having me.
Thanks, Huw. That was fantastic.
Joe, that was great. I love catching up with Huw. Again, I've known him for a long time, and he's always had really interesting thoughts on the financial sector and a great way of kind of explaining them. I do think his idea of retranching of risk in the financial system is definitely the way to think about what's happening. It seems like in some respects, you're seeing more and more specialization in the system where maybe it used to be, back in 1970 when bank lending was at its height, the bank would do all sorts of things, right? But now it kind of breaks up all those different businesses into different pieces and has different partners for each one of those.
No, I think that makes a lot of sense. Look, I would still say, and famous last words that someone will make fun of me, but I would still say that by and large, I am of the view that the post-Great Financial Crisis evolution of the financial system has probably been a net good in terms of overall financial stability risk. That to your point about the tranching, that the financial system has gotten better about putting the right form of risk in the right hands. There's never total delinkage or anything, but even hearing him explain why financial lending to financial institutions is a safer form of lending, that was really helpful, and why that's grown why, this emergence of a specific mid-market type lending and the right entities for that. I don't know. I'm still of the view that probably things are better.
It's one of those things where there could always be something that we're missing.
Yeah, of course.
And that regulators are missing. I do think at the moment we seem to be in a sweet spot where a lot of this is happening. So risk is getting divided up and, distributed differently in the financial system to where it was in 2008. But it's still relatively small, like he was saying. Despite all those headlines about private credit, like we're still talking about a relatively small market. It could be that as it gets bigger and bigger, it becomes more problematic in various ways. But the other thing that I think is interesting about private credit, and I think we've talked about it a couple of times at this point, is the idea that it kind of has acted as an additional cushion of financing during the past couple of years where we had really high rates and banks were still relatively capital constrained. So you could still get a lot of, middle market businesses had this additional layer of financing or funding that they could still tap even if the banks weren't necessarily doing it.
The winner-take-allness of banking is really interesting. I think it's one of those things that you can see and you can look at the comparison of large caps versus small caps or whatever, or JP Morgan versus literally everyone else in the U.S., but is like still sort of a little bit under-discussed why. And I get the point about the tech stack, and I get the point about, capital markets. There's a natural network effect. But it's still interesting. We live in this network effects world, and in almost any industry, this seems to be a phenomenon. And why that is across so many different areas where you have a number of companies in any industry that look like tech stocks is an interesting, under-discussed phenomenon.
Joe's theory of network effect.
You know what I say?
All in business. What do you say?
Have I told you my line? All companies are banks except banks. Banks are media companies.
That's perfect.
Yeah.
I love that. Okay, let's leave it there on a high note.
Yeah.
All right. This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Huw van Steenis. He's at Huw Steenis. Follow our producers, Carmen Rodriguez at Carmen Erman, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. And thank you to our producer, Moses Andam. And for more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a daily newsletter. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we discuss financial frenemies, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, in addition to getting our daily newsletter, you can also listen to all of our episodes absolutely ad-free. All you need to do is connect your Bloomberg account with Apple Podcasts. To do that, just find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.